Hey everybody, Martin Alexander here. I want to say thank you very much for watching this video that I have made for the Slingshot Mechanical Price-Driven Forex System. What this video is about is really very simple. It's to teach you how the strategy works, its rules, its logic, and how to implement it. First thing I'm going to do is go over the rules of the strategy, and then I'm going to provide you with quite a few trade examples so you can understand it better. The Forex Slingshot is a day trading strategy. You've got quite a few trades every single day. It doesn't go for large profit objectives in a single trade. It goes for smaller consecutive gains. And that's really one of its strengths, because I have always been a trader that's more minded towards smaller consecutive gains rather than, just one large one. Because those larger profit gains are usually much less frequent. Now, the strategy is price-driven. That means that there are no indicators used. I have used indicators in the past, and I still do, and I'm pretty successful with that. But price-driven strategies definitely have their advantages. And one of them is that price is the single best indicator in any market of where things are going. Right? Because price is telling us what's happening right now rather than 10 minutes ago or an hour ago or 2 days ago even. So this is a price-driven strategy. It works on several pairs. So that means this is a global strategy. Rather than working on just specific pairs, this works on several. It's very important to understand that. What that means is that you can use this system to trade on several currency pairs rather than just one currency pair. Specific market strategies are designed to react according to the behavior of certain markets. And most of the time, specific market strategies won't work on other markets. So this is a much more flexible strategy, and you'll see why I'm saying that here in just a minute. So let's go ahead and go over some of the specific details. We are going to be trading 4 currency pairs: the Euro, US dollar, the Great British Pound, US dollar CHF, and US dollar Japanese yen. The reason these 4 pairs work best with this system is twofold. One is these pairs have enough volatility on a short-term time frame. That allows us to capture some decent price changes on a short term. Second, they've got a very low spread in comparison to some of the other pairs. And that's pretty important because when you're day trading, you want to trade with a small spread. And the reason that's so important to us is because in day trading, we're shooting for those smaller gains, right? Another thing that's really important to understand about these pairs is that their volatility is constant rather than sporadic, okay? With other pairs, there are some that do have good volatility, okay, but it's not constant. It's very sporadic. So reliability is a key factor here. The time frame is 30 minutes, and the chart type is a bar chart. So we're going to be using a 30-minute bar chart. The trading hours, 7 GMT to 20:00 GMT. I totally recommend that you stick to these trading times. If you want to trade outside these times, you're more than welcome to do so. But the best volatility has been shown to happen during this time frame. No trading. Non-farm payroll days until 30 minutes after the report is issued. Obviously, there's no point in trading up until the point where non-farm payroll is issued because the market's just not moving anywhere. And then in the first 30 minutes after it's issued, things are crazy, so you want to stay out. And then about 30 minutes after that, you might have really some very good opportunities. So that's important as well. Recommended risk level, no more than 3% of trading capital per trade. Obviously, never risk more money than you can psychologically and financially digest, especially with a day trading strategy, okay? Because you're going to be taking quite a few trades every day. You don't want to have, 3 or 4 consecutive losers and have those losers over leveraged. That's going to really have a negative impact on you psychologically and financially. Stop loss. We're going to actually cover this in a little bit, but basically the high or low of the entry bar. And I'll explain what the entry bar is here in a little bit. The profit objective is the close of the entry bar. And again, I'll explain that in just a second. Let's go ahead real quick, and we're going to go over a long trade example and a short trade example. So first off, a long trade. A shows us what is called a setup bar. And every single bar will be a setup bar, okay? And something very important about the setup bar is the difference between its high and low has to be at least 15 pips. So if it's not at least 15 pips, it's not a valid setup bar. So once we've got a setup bar on a 30-minute bar chart, then we're going to look at point B. And that's the open of the next bar. The next bar opens here. We look at the market to see if it's going to penetrate the low of the setup bar, just like you see here. And that's what C is. Then we look for the market to reverse, and that's what point D shows us. And in fact, to cross over the close of the setup bar. This is the close of the setup bar right here, and the market crosses over that. And we exit at point E. So we exit at point E, and that's the close of the entry bar. And then we place our stop loss below the lowest point of the entry bar. So we entered at point D. We immediately place our stop loss at 1 pip below the lowest point of the entry bar. All right, now let's take a look at a short trade example. We basically just reverse the rules. A shows us a setup bar. B shows us the entry bar opening. The market penetrates the high of the setup bar. That's C. D shows us the market would have reversed and crossed the close of the setup bar. And then we would have exited at the close of the entry bar here at E. And we would have placed our stop loss above here. So why does the strategy work? Well, there is the unexpected factor. This is a very important psychological aspect. The unexpected factor is part of the market psychology argument. And that is that whatever people least expect to happen, that's what actually happens. So when everybody sees that the market is breaking out of a 30-minute bar, and then the market reverses and everybody's closing their position, then the market tends to go to the other side. And that's a very well-known psychological trigger. And it works, okay? I mean, it works. Not on a very small time frame, like a 1-minute or a 5-minute bar chart. But on a 30-minute chart, up to an hour chart, it works. Length of trade. Again, this is very important. The fact that you're looking for small profit objectives makes this work even better. This is a very short-term reversal. Okay, so you've got to take advantage of that. You've got a window of opportunity. That's what you got to take advantage of. So don't expect to see a trade moving, 100 pips in your favor on a 30-minute bar chart. Okay, so this is the end of video number 1. Video number 2, we're going to go over quite a few examples so that you can see this concept in action and how the Slingshot 30M works, okay? I'll see you in the next video.